Hi, everybody, and welcome back to video number 6 in Chapter 12. When we left off, we had just completed the adjusting entry um, to record the estimated warranty expense and liability uh, for an assurance warranty through December 31, 2025. Now, the balance sheet is going to report a liability of $200 for the assurance type warranty costs in 2026 and 2025. And the income statement for 2025 is going to report sales revenue of $30,000 and warranty expense of $700. Okay. And now we're going to recognize revenue in 2028. We'll prepare the entry to record the revenue recognized in 2028 on the service type warranty. That's January 1 through December 31, 2028. And we're going to record unearned warranty revenue. We're taking 3 years, total of $900 on a straight line basis, and this would be the last year. So it's going to be $300 here with additional, we will have recognized the last $300 of our warranty revenue. Okay. The warranty costs under the service type warranty will be expensed as incurred in 2028 to 2030. Expensed as incurred. Okay, consideration payable here. Companies should charge the cost of premiums and coupons to expense in the period of that sale that benefits from the plan. So the company is going to estimate the number of outstanding premium offers that customers will present for redemption, and the company then charges the cost of premium offers to premium expense and credits premium liability. Let's take a look at an illustration. Fluffy Cake Mix Company sells boxes of cake mix for $3 a box. In addition, Fluffy Cake Mix offers its customers a large, durable mixing bowl in exchange for $1 and 10 box tops. The mixing bowl costs Fluffy Cake Mix $2, and the company estimates that customers will redeem 60% of the box tops. The premium offer began in June 2025. During 2025, Fluffy Cake Mix purchased 20,000 mixing bowls at $2 apiece, sold 300,000 boxes of cake mix for $3 per box, and redeemed 60,000 box tops. Number 1, prepare the journal entry to record the purchase of 20,000 mixing bowls at $2 per bowl in 2025. This one's pretty easy. We're going to debit premium inventory, 20,000 bowls at $2 a piece, $40,000, and credit cash to pay for it. Now, number 2, we're going to prepare the journal entry to record the sale of the cake mix boxes in 2025. Here we had 300,000 boxes of cake mix at $3 per box, so that's $900,000 we're going to receive in cash and credit sales revenue for $900,000. However, we need to prepare an entry to record the redemption of the 60,000 box tops. We got $1 per box top and 10 box tops, which were not really worth anything, and delivery of the mixing bowls. So our cost is going to be 60,000 box tops. We're going to divide that by 10, right? And multiply that by 1. So we had 6,000 of these mixing bowls. And the premium expense, therefore, is going to be $12,000 minus that $2 and less the expense, which was $1. All right. Okay, so they received $1 here, but it cost them $2 here, right? So that's why this is $6,000. And the premium inventory is going to go down by 6,000 times $2. Okay. And number 4, here we're going to prepare the adjusting entry to record additional premium expense and the estimated premium liabilities. So the total box tops sold were 300,000 box tops, $300,000. The estimated redemptions were 60% of that, so 180,000. The cost of the estimated redemptions, we have 80,000 box, $180,000 box tops divided by 10. That gives me 18,000. And then the cost of that's going to be $18,000. Redemptions to date, which we've already booked in the prior slide, we have $6,000. And so our liability at the end of 2025 is going to be $12,000. And that's how we book it. A debit to premium expense, $12,000, and a credit to premium liability, $12,000 at the end of 2025. All right, gain contingencies here. Typical gain contingencies are 1, possible receipts of money from gifts, donations, asset sales, etc. Number 2, possible refunds from government and tax disputes. Number 3, pending court cases with a probable favorable outcome. And number 4, tax loss carryforwards. All right, we haven't done a lot on tax loss carryforwards, but that subject will be coming. All right, gain contingencies are not recorded. Disclosed only if the probability of receipts is very high. We would disclose that in a note. Let's take a look at an illustration. I-Chapt is a plaintiff in a class action lawsuit against a drug manufacturer. The lawsuit is finally settled in I-Chapt's favor, and the settlement amount is put in escrow to be divided among various plaintiffs and their attorneys. Presently, there is no agreement as to how to allocate the money among the plaintiffs. How should I-Chapt record a gain for this contingency? I-Chapt has a gain contingency because the amount of cash to be received is not yet known. However, any possible gain related to the lawsuit should not be recorded in the financial statements because the company should not recognize revenue before its realization. However, if the settlement amount to be paid to I-Chapt is known, and the settlement funds will be paid out shortly, I-Chapt then should record a receivable for the amount to be received and a gain reported in the financial statements. Pretty straightforward there, I think. Now, here, we'll put this all into practice. Preferred Travel has the following transactions that may or may not require recognition of contingencies. Number 1, during the year, Preferred Travel sold high-end travel accessories to customers who purchased its vacation packages. Preferred Travel offers a 2-year assurance warranty for these accessories. The company sold the items for $400,000 and estimates that warranty costs will be 5% of the amount sold. During the current year, it spent $8,000 in servicing warranty claims. Number 2, Preferred Travel also sold specific vacation packages related to fishing expeditions. The company sold 3,000 of these vacation packages that cost $500 per package. When the customer purchases one of these vacation packages, the customer also receives a coupon, giving the customer the right to a child's tackle box, which has a value of $10 and also might be used as your petty cash fund as well. Anyway, the customer must also remit $1 with the coupon to receive the tackle box. During the year, customers returned 800 coupons. It is estimated that 60% of the customers will send in their coupon. The tackle box cost Preferred Travel $4, and during the year, 2,500 tackle boxes were purchased by Preferred Travel for possible disbursement. Number 3, as a result of uninsured accidents during the year, personal injury suits for $350,000 and $60,000 have been filed against the company. It is the judgment of legal counsel that an unfavorable outcome is unlikely in the $60,000 case, but that an unfavorable verdict approximating $250,000, which can be reasonably estimated, will probably result in the $350,000 case. Number 4, Preferred Travel is involved with one of its suppliers who failed to provide proper safeguards for its customers during a recent trip. As a result, a substantial number of customers decided to return home in the middle of the trip and demanded refunds, which amounted to $200,000. Preferred Travel paid the $200,000, but has now sued the supplier. The attorney for Preferred Travel believes Preferred Travel will win the lawsuit, indicating that the company's chances are at least 70%. That's a high level of confidence. All right, so let's look at these. So if we record the sales of the vacation packages here, we'll debit cash because we received it and credit sales revenue for $400,000. Pretty straightforward there. We're going to record the payment for warranty costs by debiting warranty expense for the $8,000 and crediting cash, inventory, or accrued payroll as appropriate for another $8,000. Then we're going to record the estimated warranty expense and warranty liability claims here. We'll debit warranty expense for $12,000 and credit warranty liability for $12,000, and we compute that by taking 5% of the $400,000 and then backing out this $8,000 that we did here, that we've already paid. Okay, then we're going to record the sale of the vacation packages. Here we'll debit cash for $1.5 million, and we got that by multiplying $500 times 3,000 packages for sales revenue of $1.5 million credit. Then we'll record the purchase of premiums, the premium inventory for $10,000, and we paid it in cash for $10,000, and we bought 2,500 of these tackle boxes at $4 a piece. And during the year, we are going to record the cash of $1 times 800. The premium expense will be the 3,200 minus 800 here, and the premium inventory 4 times 800. That looks like a good place to stop this video, and when we return, we'll take a look at additional contingency considerations. Until that time, bye for now.